Welcome back, traders. With the market selling off more than 1% on the S&P 500 and the triple Qs, we have seen the markets take a turn to the downside, and we have seen on Friday's trading session more than $3.4 trillion of options expiration, leaving many traders feeling the max pain effect. So in today's video, we are going to be discussing whether or not if this is more than a sell-off to be reset to a move higher, or will we be experiencing more downside from this point forward. As we can see, the VIX is up nearly 7%, with volatility much higher on Friday's trading session. So in today's video, we are going to be discussing the price action that took place on Friday's trading session, so that way we can be better prepared for the next trading session. So if you haven't already, please go ahead and leave a like down below. Please go ahead and subscribe to the channel. And if you know anybody that would find this video useful, please go ahead and share this video. We would greatly appreciate it. So without further ado, let's get right into it. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax. Now let's get into it. So Friday's trading session was a deep doo-doo. The market sold off massively on Wednesday to Thursday. We have seen a gap up for a move higher, and then on Thursday to Friday, we've seen a gap down, with much of the trading session selling off to the downside, closing near the lows. So we saw the same effect take place. So this is the S&P 500. We saw the same effect take place on the triple Qs, selling off more than negative 1.71%. So we saw the same thing take place on Wednesday to Thursday, a gap up, and then from Thursday to Friday, a gap down, with much of the market selling off, closing off near the low. Now, we have seen a big U-turn as far as what we were expecting on Thursday's video, that we were closing up near September 1st trading session, where we were nearly just down negative 0.18%. And then on Friday's trading session, it just gave it all away. We sold off, and now we are down negative 1.73%. Now, the question now is whether or not if this triple witching event is going to take us down even further, or if we should be expecting a recovery bounce sometime soon to close off September to the upside. And there's a lot of things that we need to look at. First and foremost, we have to be paying attention to the Wednesday event. So as we know, Wednesday is going to be a big market mover with the FOMC meeting. This is going to be taking place at 11 a.m. Pacific Standard Time. So mark your calendars. Even though we know that this is a big event, and based off of this CME watch tool of the Fed's probabilities on whether or not they are going to ease, no change, or hike their interest rates, we are seeing and expecting that majority expect that there should not be any interest rate hikes at this point. However, that does not mean that we are cleared for the way for a move higher, because even though that the US markets are probably going to be held on a pause for interest rates, it doesn't mean that the Fed will still talk the market down with what they say. You know, the Fed's words are very important, so which is why it's very important to tune in, and we as a team will be watching this very carefully to really see how the markets will react. Because whether or not if the Fed talks dovish or talks hawkish with higher interest rates to come for the future, it's very important to see how the markets will react to whatever the Fed Jerome Powell will say on that day. So that is one of the major things that we're going to be preparing for, so that way we can start making our trades. Now, as we can see, going back to the charts, this is just looking at the daily charts. We see that we are now at the 50 moving exponential moving average for the S&P 500. We back here on September 7th, we tapped it and moved up. However, on Friday's trading session, we went right through it and closed right under. Now, I would say just by looking at the exponential moving average, we would take that more of a trading range because we already know that we closed down below or opened down below on this moving average, but now we are right under. So the question now is whether or not if we will be going down further. But from what we can see on the different indicators, we are seeing a flattish to a little bit of a crossover on the MACD to pretty much tell us that we might be just stuck in a trading range. But Friday on Wednesday's trading session, it might really change the picture, which is why we need to pay very close attention to whether or not the Fed will talk the market down, and if that happens, then we're looking at lower levels on the markets, maybe possibly even closer down towards 433 on the S&P 500. Now, looking at the triple Qs, we are seeing similar but slightly different, right? We see that we came close, but not under the 50 moving exponential average on the daily candles for the triple Qs. In fact, we have this little slight wick, bottom wick on the candle on Friday's trading session, meaning that we came down below, but then we closed higher above the lowest trading point for Friday's trading session. Um, so we are not under the 50 moving exponential moving average, which is a good sign because that just means that we are finding demand around this area. But again, that could change on Wednesday, so we need to pay attention. On the MACD, we are seeing uh, a slight pull in to the blue line over the yellow line, which would typically signify a change in trend if this blue line goes under. However, again, we are actually above the zero line, which is actually a good sign that positive momentum can still continue to the upside. So how do we determine, whether or not we should be worried or not? Well, it's going to depend on the price action that we get really on Wednesday, and just by really listening to whether or not if the Fed will cause a lot more fear with what he says, and we just need to pay attention. So now that we're done looking at the daily chart, we want to look at and zoom out a little further because we are seeing still positive upside momentum based off of these moving averages. And obviously, when you zoom out even further, these moving averages will give us a better reading as far as where price will possibly hold or even bounce off of. So we are seeing positive reading. All the major moving averages are still inclining to the upside, and so that is good for the triple Qs. Again, for the S&P 500 on the weekly candle, we are still seeing upside sloping on the moving averages, so that is good. But again, the MACD is turning to the negative side, so we're getting conflicting reading. And now, what we also want to pay attention to is the VIX. So with the VIX, we can see that the VIX popped up on Friday, but not over this moving average, which has been held many days in a row as a form of resistance. So this is actually a good sign if we're looking at the VIX alone. We have the VIX that uh, rejected this trading session that happened on September 6th, as well as September 7th and September 8th, and then again on September 13th, and once more on Friday's trading session. However, this was the first green VIX day that happened in the past 2 days. So this is quite positive of a reading that we can expect that volatility is still tamed. We should not be fearful of sell-offs that happen in the market because when we have a contained VIX, that could only mean that we will be experiencing less volatility, which is easier to trade in. Whenever we have a contained VIX, any sell-off could present to us a buying opportunity, which is why I am still remaining positive for the markets. Um, and I will continue to be buying into these dips until the trend changes. But as far as right now goes, uh, I'm staying quite positive, and the deeper the the market sells off, especially on Friday, I was buying and adding into many positions because these are times and opportunities as a trader especially in a sideways trading uh, price action that we're currently seeing. These dips and opportunities are opportunities to buy into and really start to dollar cost average in to many of your positions. And if you're trading options, these are opportunities where you could buy in and pick up really good premiums at really good prices. So these sell-offs that we seen on Friday, do not run away from them. In fact, find the opportunities within them so that way you can have the best positioning if you're trading to the upside. Now, again, if there's always downside risk, and so which is why as a trader it's very important to respect your stop losses because once they hit your stop losses, it's always important to get out of them because that stop loss is supposed to protect you from substantial losses in your account, which is a good measure and a good practice to undertake as a trader who wants to be able to trade for the long term. Again, as a trader, we always have to understand that losses are inevitable and we have to embrace them because that only allows us to continue to trade and find the next opportunity whenever they present itself. So that is what I have for you today. If you like this video, please go ahead and subscribe to the channel. Please leave a like down below, and we will see you on the next one.